For this series, I created a portfolio from 10 stocks belonging to 10 different industries that not only pays an average dividend yield that is almost 3 times the yield of an index fund that tracks the S&P 500, but also outperforms the year-to-date gains of the S&P 500. As shown in the pie chart, my portfolio of diversified high dividend yield stocks has achieved a year-to-date gain of 23.11%, almost 8% better than the year-to-date performance of SPY ETF, while paying out an average of 3.6% in dividends, more than 2.2% higher than the dividend payout of SPY. This portfolio is evenly distributed into 10 different industries, including banking and capital markets, oil and gas, information technology, aerospace and defense, pharmaceuticals, tobacco, food and beverages, life insurance, communication equipment, and retail to evenly distribute investment risks among different industries. Best Buy, ticker symbol BBY, is my first pick. Best Buy is a retail stock and pays out an annual dividend yield of 2.42%. For the year, Best Buy is up 15.1% year to date. Best Buy has a price-to-earning ratio, or P/E ratio, of 13.55. The P/E ratio is a ratio of a company's share price to the company's earnings per share. The ratio is the simplest gauge to determine a company's value and to determine whether the company is overvalued or undervalued. So assuming a company has positive earnings, then typically the lower the P/E ratio, the better it is, as it is one indication that the price of the stock is cheaper relative to the earning of the stock. The P/E ratio, however, by itself is almost meaningless. But when we compare the P/E ratio of a company such as Best Buy with the average P/E ratios of companies in the same industry, such as in Best Buy's case, in the retail industry, then we can see that the P/E ratio of Best Buy is almost half the average industry P/E ratio of 25.44 times earnings. In addition to looking at the P/E ratio, I also looked at several other metrics, including the price to sales, price to book, current ratio, debit, estimated growth, and many other metrics which we will not get into in this video. However, let me know in the comments below if you would like to see another video where I go through each metric I look at when I evaluate whether to purchase a stock. In addition to P/E, Best Buy has been consistently increasing its dividend payout amount since at least 2011. Moreover, Best Buy learned how to not only coexist with an internet retail behemoth like Amazon, but also survive during COVID. I am putting my money on Best Buy to continue its upward trend as we exit COVID and Best Buy stores receive more and more foot traffic. Cisco Systems, or Cisco, ticker symbol CSCO, is my second pick. Cisco is a communications equipment stock that pays out an annual dividend yield of 2.76%. Cisco has been consistently paying its quarterly dividend since at least 2011 and has increased its quarterly dividend payout amount several times from 6 cents a share in 2011 to 37 cents a share today. The last dividend increase occurred in April 2021 when the dividend payout increased a little less than 3% from 36 cents a share to 37 cents a share. For the year, Cisco is up 21.79% compared to the 17.6% gain by the S&P 500. And Cisco has a P/E ratio of 22.11x earnings, which is a little more than 25% lower than the average industry P/E ratio of 29.7 times earnings. ExxonMobil, or Exxon, ticker symbol XOM, is my third pick. Exxon is an oil and gas stock that pays out an annual dividend yield of 5.51%. Exxon has been consistently paying quarterly dividends since at least 2013 and is currently paying a dividend of 87 cents per share. Exxon and the oil and gas industry in general were particularly hit hard by COVID. During one time last year, the futures price for a barrel of West Texas Intermediate crude actually inversed to negative $37.63 per barrel. At one point, there were significant concerns on whether Exxon can retain its dividend payout. However, Exxon, to its credit, has been getting leaner and more efficient ever since pre-COVID, while maintaining its upstream and downstream capabilities, which at one time made Exxon the most valuable publicly traded stock. For the year, Exxon is up a whopping 52.22% year to date compared to the 17.6% gain by the S&P 500. This is a reflection of investors' faith and confidence in Exxon making the right business decisions to right its ship as Exxon navigates the post-COVID oil and gas landscape without cutting its dividend. The world today still mostly runs on oil and gas, and as the world emerges from COVID and travel further picks up, I can see Exxon stock price continue its upward trend. Goldman Sachs, ticker symbol GS, is my fourth pick. Goldman Sachs is a banking and capital market stock. Goldman Sachs has been consistently paying quarterly dividends since at least 2013 and recently announced its decision to hike quarterly dividend from $1.25 per share by a whopping 60% to $2 per share. Goldman Sachs typically is not included in a high dividend yield portfolio, but Goldman Sachs numbers and metrics were just so amazing when I analyzed Goldman Sachs that I had to include Goldman Sachs in my portfolio. For the year, Goldman Sachs is up 41.19%, outperforming the S&P 500 by almost 24% year to date. This is no surprise by the banner year that Goldman Sachs is having and the record top and bottom earnings that Goldman Sachs has reported, which beat out analyst estimates. Goldman Sachs P/E ratio is currently 9.31x earnings, which is around 60% of the average industry price to earning ratio of 14.84x earnings. Stocks I would consider if I'm more focused on obtaining higher dividend payout would include Citi or C, which is up 17% a year and pays out a dividend yield close to 3%, or a Canadian bank. However, my opinion is that Goldman Sachs has a lot more room upwards, and I would trade being paid slightly less in dividends for a stock that has a chance to have significant upwards price movement. IBM, ticker symbol IBM, is my fifth pick. IBM is an information technology stock and pays out an annual dividend yield of 4.69%. IBM has been consistently paying out quarterly dividends since at least the last 10 years, and in May 2021 increased its quarterly dividend payout from $1.63 per share to $1.64 per share. For the year, IBM is up 12.97% year to date after suffering a near 5% drop this Friday, after the company announced that President Jim Whitehurst, who was the CEO of Red Hat, is stepping down as president. I think this is an overreaction. Although Whitehurst has been instrumental to forming and broadening IBM's hybrid cloud footprint, I do not see Whitehurst's departure as a sign that IBM will not continue its transformation to a cloud, hybrid, and AI company. Further, IBM has been shedding much of its excess weight over the last several years, and the present-day IBM is a much leaner and more efficient company with a clear focus on hybrid cloud and AI computing. IBM's price per earning ratio is 23.41, which is less than half of the average of the industry P/E ratio of 67.32. Further, IBM is one of the few technology-related companies that pays a dividend greater than 2%, thereby making IBM an attractive investment for dividend investors looking to diversify into technology. Lockheed Martin, or Lockheed, ticker symbol LMT, is my sixth pick. Lockheed Martin is an aerospace and defense company that pays out an annual dividend yield of 2.73%. Lockheed currently pays a quarterly dividend of $2.60 per share. Over the last 3 years, Lockheed Martin has hiked quarterly dividends by 20 cents per share every year in November. And if this pattern continues, then Lockheed's dividends should increase to $2.80 per share in November 2021. For the year, Lockheed is up 10.7% year to date, which underperforms the S&P 500 by approximately 7%. However, in the current geopolitical environment, defense business will not slow down anytime soon and will likely pick up due to the ongoing geopolitical tensions. As for Lockheed Martin, it recently agreed to a $5.5 billion deal to supply Switzerland with F-35A Lightning fighter jets, which, with the exception of the F-22 Raptor, is the best fighter jet out there and is the best fighter jet money can buy, second to none. Given the ongoing geopolitical tensions, I foresee more countries attempting to upgrade their air superiority through Lockheed Martin. Lockheed's price per earning ratio is 15.39, which is less than 5.5% of the average industry P/E ratio of 283.82. McDonald's, ticker symbol MCD, is my 7th pick. McDonald's is a food and beverages stock that pays out a dividend of 2.21%. McDonald's currently pays a quarterly dividend of $1.29 per share. Over the last 8 years, McDonald's has hiked dividends once a year in November. So if this pattern continues, McDonald's dividend should increase again in November 2021. The food and beverages industry is a particularly tough industry to be in, and it was hit hard by COVID. However, McDonald's is the best known fast food company, and with 12,000 locations, many of which have drive-thrus, McDonald's navigated its way through COVID pandemic recently well. For the year, McDonald's is up 11.14% and has been trading mostly within a $10 range within the last 3 months. As we exit out of the COVID pandemic, indoor dining will pick up, which should further improve McDonald's top and bottom lines, which will therefore lead to better stock performance. McDonald's has a P/E ratio of 33.97, slightly less than the average industry P/E ratio of 35.25. An alternative to McDonald's is Coca-Cola, which has a higher dividend yield of 3.1%, but is currently up 2.69% year to date, or around 8.5% less than McDonald's. Both companies are stable companies in the food and beverages industry, so the choice is really whether the greater focus is on higher dividend payouts or higher investment returns due to appreciation of the underlying equity. Pfizer, ticker symbol PFE, is my 8th pick. Pfizer is a pharmaceutical stock that pays out a dividend of 3.93%. Not counting special dividends, Pfizer has been consistently raising its quarterly dividend payout amount in November every year since at least 2014. If this pattern holds, then I anticipate Pfizer raising its dividend payout amount again in November 2021. For the year, Pfizer is up 7.93% year to date, underperforming the S&P 500 by almost 10% year to date. However, with a global shortage of COVID vaccines and Pfizer vaccine generally being considered as the best vaccine available, many countries are lining up to purchase Pfizer vaccines. Moreover, in addition to manufacturing COVID vaccines, Pfizer products such as Prevenir, Ibrance, and Eliquis each generate at least $4 billion of revenue a year. Pfizer's price to earning ratio is currently 20.15, or less than a third of the average industry price to earning ratio of 74.3x earnings. Philip Morris International, or Philip Morris, ticker symbol PM, is my 9th pick. Philip Morris is a tobacco manufacturing company with products such as Marlboro that are sold in over 180 countries. Philip Morris has an annual dividend yield of 4.79% and has been consistently raising its dividend payout once a year since at least 2013. Based on Philip Morris's dividend payout pattern, Philip Morris current quarterly dividend of $1.20 per share is due for another hike in September 2021. For the year, Philip Morris is up over 23%, outperforming the S&P 500 by around 5.5%. Philip Morris benefits from operating outside of the U.S., where many tobacco laws are less stringent than U.S. laws, where tobacco products are associated with less negative connotations, and where a greater number of international population use tobacco products. Philip Morris's price per earning ratio is 23.41, almost a third of the average industry price to earning ratio of 67.32x earnings. And my 10th and final pick is Prudential Financial, or Prudential, ticker symbol PRU. Prudential is a health insurance company that pays an annual dividend of 4.46%. For the year, Prudential is up 34.99%, more than doubling the S&P 500 year-to-date gain of 17.61%. This is anticipated as health insurance companies are generally moderately inflationary resistant and generally do well during moderate inflationary periods. The big news that we keep on hearing is inflation and what inflation will do to our economy. Although I do believe that we are experiencing inflation, this is nothing like the inflation we experienced back in the 70s. And in this type of moderately inflationary type of environment, health insurance companies like Prudential are going to outperform the market. Prudential has a current price to earning ratio of 15.48, which is slightly higher than the industry average P/E ratio of 14.6 times earnings. This spreadsheet provides another breakdown of my $100,000 portfolio. Assuming there is no further changes to the dividend payouts, the total annual dividend payout is $3,557 or $296 a month. However, with dividend reinvestment, which I strongly recommend, the payouts are reinvested into the underlying stocks, thereby adding to my holdings of the respective underlying stocks. This approach compounds my returns over time and actually increases the passive income generated by this portfolio to more than $300 a month in the first year. However, if you're interested in achieving even higher returns, then feel free to click on the links I provided. If you want to check out my other series where I utilize more risky strategies to 10x and 50x my returns. Let me know what your dividend investment strategies are and which stocks you have in your dividend portfolio in the comments below. As always, thank you for watching and please hit the like and subscribe buttons.